I want to ask you about, I was thinking, which is dangerous, but in tech, we're talking about recession fears, certainly slowdown issues based on some of the reports we've seen. Is it time to isolate some productivity and efficiency plays, say within enterprise tech? Names like ServiceNow, PagerDuty, even Workday, that companies might need to look at if they're pulling back, if they're looking to see where they can save a penny, either because their stocks are going to outperform, or because they become buyout targets.
Yeah. So great question. Let me just level set where we are right now. So if you just look year to date, the S&P is up about 17%. The Dow is up 12% or so, give or take. NASDAQ's up 17%. A couple things there. When you think about the performance right now of the IPOs that have come out this year. So this year, we've had about 30 tech IPOs. Now, on average, those IPOs are up about 35% plus. So it's been a great year for IPOs, right? Secondarily, if you stripped out ride sharing, actually IPOs are up over 50%. So it's been actually a really good year for IPOs. We
haven't heard that yet. Yeah, X-ride sharing.
X-ride sharing, right? So it's interesting as far as how investors have been doing so far by riding tech, and particularly when you look at the portfolio managers that are out there that are behind their benchmarks, right? And they're looking for that incremental alpha. You're seeing this robust demand for IPOs, right? Now, as to address your question, there's a couple things there. I think you're right. I think some of the names you mentioned, if you see a pullback on growth by companies, you'll see those stocks less impacted, right? So they'll be a little more defensive in nature than some of the growth companies. But I think almost every single one of our companies is talking about is we're cautiously optimistic that we're not hitting a recession in the near term. No one truly really knows, but they're going to operate their business plans, cautiously, still going for growth, still going after their major plans until they see any signs that maybe they need to pull back. And in that case, John, your answer would be exactly right. More of those productivity suites would be really helpful.
One of the questions I've heard raised this week, WeWork dropped its filing this week. A lot of focus and a lot of criticism about the quality of the numbers there, the ownership structure, et cetera, is when you see a company like that now looking to come to market, does it signal a market top?
It's a great question. And while I can't answer directly on WeWork, what I can say is that by far and away over this last year, and really say almost since the ride sharings came out, you're seeing more and more emphasis by investors and boards and management on unit economics. I think the key for any of these things that come out, any of these names, is look at the key unit economics. Are they making a profit on their core business? And if so, how much of a profit? Do you hit the accelerator and do more marketing because it's a great ROI? Or do you actually pull back as you try and improve some of your unit economics there? So I think by far and away for these issues that will be coming, you'll see investors look very, very closely at that unit economics.
What do you think it would take for so-called value investing to come back and replace large cap tech?
Yeah.
That would be a huge sea change.
It would be, and maybe if you do hit this recession, that's where you see that take place. What I think is interesting is that you've seen private valuations as well as public valuations, right? If you think on the private side, there's actually been some really robust markets there. It's easy to get capital, you can fund your plans privately and then ultimately go public later. I was meeting with a prominent venture capitalist you would know well, and we were talking about valuations, and he said, it's funny because I'm seeing increased competition. I'm not necessarily getting the valuations I used to that I wanted to. However, having said that, I could have told you the same thing back in 2015. Look at all these tremendous gains I would have missed out on. So you're seeing more competition for the more coveted names on the private side, but they've been working, and that's been the key part. Now, on the public side, if you look at that for a second, multiples are in the range where they've been, right? So EV to revs is somewhere around 5-6 times. EV to EBITDA is in the mid-teens to low teens. So they really haven't egregiously gone away from where we are, even though we were just at all-time highs in July.
Is this a unit economics issue with this S1s that we're going to see here, or is it a ride-sharing specific issue? And I ask that because WeWork is another one that kind of falls under the same types of questions that we saw for Lyft and Uber. Airbnb, a little bit different business model, but still in that kind of sharing stuff that we haven't shared before business model. Are they going to undergo the same kind of scrutiny? And given how poorly Uber has performed, is it overdone?
Yeah.
I mean, it's below the IPO price. If you liked it before that day, you should love it now.
So absolutely, for all these companies coming, I think the unit economics is the critical issue. And you can take that back to almost every story that's come out recently, whether it's Chewy's, Revolve, The RealReal, the ride-sharing guys. What I think is interesting, you're seeing management teams and S1s now incorporate more data around that. Look at cohort analysis. Look at LTV to CAC ratios. Those types of things that can help an investor realize, okay, these losses is really incremental investment and not just incremental spend, if that makes sense.
Does the S1 take that a step too far? Because people are calling it the unicorniest unicorn we've seen in a generation of unicorns.
Yeah. Well, I can't answer specifically on WeWork, but what I can say, though, is that I think for certain scenarios, you want to see what happens if we have a recession scenario. What happens to the business model at that point? Can you cut back? How much of your expense is variable versus fixed? And how much could you pare back if you entered a prolonged recession, right? And then how much is actually in the contracts? Are there long-term contracts here I can rely on? Is there a big backlog I can think about? Things like that to give investors more pause that if and when we do have this recession, that the companies they're looking at can withstand them.